Yeah, good morning, guys. Today we are going to discuss about the Indian Accounting Standard 2, which define the inventory. Now, if we are talking about inventories, we have a different kind of the inventories. So if inventories are there in our business, how we are going to treat that inventories in our financial statement? That we are going to discuss here about inventories in our Indian Accounting Standard 2. So in this inventory, we are going to discuss what is the meaning of inventories, how we will recognize, how we will know that this is inventory only, what are the examples of the same, and how we are going to measure it. And in that measurement, what the costs will be involved. Okay, so let's start. So if we talk about the meaning, inventories are the items which should be held for the sale in the ordinary course of business. Okay, all that items could be your inventory if for that purpose only you have doing your business. Okay, for selling that inventories only if you are doing that business. Okay, so basically whatever the items you are having for the trading purpose, that all if you are selling it in an ordinary course of business, so that all will be treated as the inventory. Or if in the process of the production of such sale. Okay, if you are having any item, for example, you are using oil or the petrol for the production of these inventories only, so that also will be counted in your inventories. Or if any item which you are in the form of material or supplies you are consumed in the process of the production or in rendering service, that all will be your inventories. Okay, so basically what is inventories? If it is held for the sale in an ordinary course of business. Okay, now what are the different kind of inventories are there? That inventories could be the merchandise, where what is the meaning of merchandise here? That goods should be there for the resale purpose. Okay, for example, if we have purchased some goods from the manufacturer, we all are the retailers and we have purchased some goods from the manufacturer. So whatever goods we have purchased that all are the finished good only, but we have purchased from the manufacturer for the resale purpose. Okay, so that all the finished products will be for the retailers, that all finished products will be the inventory. Okay, or if any production supplies are there like a oil or the petrol, that all also will be called as inventories or will be included in the inventories. If any materials we are using like raw materials, that raw material could be your iron, steel, plastic, okay, anything that we are using in the production of the goods, or work in progress, or any finished goods. Okay, all these five kind of items will be your inventories, will be treated as the inventories. Okay, now we have figured out that what is the inventory. Now if we have already know what is the inventory, then how we are going to, the next question is how we are going to measure it. Okay, the rule for the measurement of inventories is there in Indian Accounting Standard 2. That is, whatever the cost or the net realizable value of that inventory is there. Okay, the lower of the cost or the net realizable value will be measured at will be the cost of the inventory that we are going to show it in a financial statement. Okay, now what is this cost and what is the net realizable value? So before just fixing or before just transferring the amount to the inventories, first we need to calculate what is the total cost of this inventory, or what is the total net realizable value of this inventory. Whichever amount will be lower, that only will be the amount of inventory which we are going to show in our financial statement. Okay, the cost will be here if any purchase we have done, we have purchased something to make this inventories. We have incurred some cost on the conversion of this inventory, or we have some incurred some other expenses also in selling that inventory. So that all will be your cost of the inventory. What is now the net realizable value? Whatever the expected selling price of this inventory is there, when we will deduct the cost of sale, okay, expected cost of sale, then whatever the amount will come, that will be your net realizable value. Okay, some exceptions are there in these inventories only, where we are not going to apply this rule. Okay, either it will be at cost or either it will be net realizable value. Not both, we have to calculate and we have to see what is the lower amount. Okay, some exceptions are there. What are these exceptions? Like producers of the agriculture forest product, if any agricultural or the forest products are there, we are not going to apply this rule. If any minerals or mineral products are there, we are not going to apply these rule. If these products are there, whether it is an agricultural product, whether it is a forest, whether it is a minerals, whether it is a products made by the minerals. If these are there, that should be measured at a net realizable value only. Okay, we need not to just compare whether it cost is low or the net realizable value. Only whatever the net realizable value is there, on that only we will record the amount of inventories in this exceptions. What is next exception? If commodity dealers are there or the brokers are there, commodity brokers are there, for them fair value of that inventory will be recorded in the financial statement. Okay, now if we have to calculate the cost of the inventory, so what are the things we need to take to calculate the cost of the same? So yeah. So what are the costs we are going to involve in the calculation of your total cost of the inventory? So very first cost will be cost of the purchase. Okay. Now in this cost of purchase, what are the amounts we are going to take? Everything we have to add all together, then only we will get the cost of the inventory. Okay. What are the costs involved? In that cost, there could be a purchase price. Okay, there should be a purchase price of that inventory. Okay, import duty, if any is there, we have to add that. If any non-refundable tax is there, we have to add that non-refundable tax. Then if any directly attributable costs are there of the finished goods. Okay, directly attributable cost here means which is directly related to your or directly added just added the cost of the inventory. Okay, so if any dark amount is there of the finished good, like the transport or installation, whatever, so that all we are going to add. And if any trade discount is there, we have to deduct it. Okay, so this all will be included in your cost of purchase. Now you have to add all these items together, all these amounts together, then you will have the cost of purchase. Now in this cost of purchase, you have to add a cost of conversion. Okay, now in this conversion, what all costs will be included? So conversion of this from the raw material, that conversion of raw material to the finished good. Okay, whatever cost will be involved, that all will be taken here into the cost of conversion. Okay, that could be your direct materials, whatever the direct materials you have taken to make your product, whatever the direct labors you have charged to make that product, whatever the indirect expenses you have incurred to make that product. Okay, so all the cost of conversion, from the conversion here means converted from raw material to the finished good. whatever the costs is being involved, everything you are going to add. Okay. Now you have added all the cost of the purchase, you have added all the cost of the conversion. Apart from it, if any other cost is involved there, okay, like if you the raw material you have bring from the other location, okay, to your location. So present location bringing, if you any cost you are incurring, that also should be added in this cost of the inventory. So if you will add all the costs together, you will get your cost of the inventory. Okay. Now, after having this cost of the inventory, you have to also figure out what is the net realizable value. How we are going to calculate? Whatever expected selling price of that inventory is there, we have to deduct all the cost of the sale. Okay. After just going for sale, whatever the cost we have involved, cost of the sale, we have to deduct, then only we will get our net realizable value. Okay. After having cost and the net realizable value, you have to compare which amount is less. If the cost is coming less, so that amount only will be recorded in your financial statement. If your net realizable value is less, so in that case, that will be treated as an amount of inventory in your financial statement. Okay. Now, in calculating the cost of the inventories, some items are there which we should not take. Some amounts are there which we should not add at the time of calculation of cost of inventories. Now, what are these costs? So first is abnormal waste. Okay, abnormal waste in terms of material or in terms of labor, or if any other are there. If that all are abnormal waste. Abnormal waste here means you were not included in your cost of the goods. Okay, that amount. So if that kind of waste is included there, then it will be your abnormal waste. So that abnormal waste amount you are not going to add in your cost of inventory. Okay. For example, if any loss has happened just because of the earthquake or the flood, okay, that destroyed your raw material or the finished good and all. So in that case, we are not going to take that loss in your cost of the inventory. Second is storage cost. Okay, storage cost here means after making that product, you are going to just keep it in the warehouse. So the cost of the same you are not going to include in your cost of the inventories. Then administrative overheads, if any is there, okay, then you are not going to take, and the selling cost. Okay, so these things you will not take into account while calculating the cost of the inventories. So this is all about the introduction of the inventories accounting according to Indian Accounting Standard 2. Thank you, guys.